live video. My name is May Doldelau, and today I am talking about investing in the S&P versus the All Seasons. See the shocking results, okay? Like I said, my name is May. I live in Waikiki, Hawaii with my husband Jamel and our 7-year-old son Jordan. We own this condo and another condo down the street, which is an Airbnb business. Now, back in 2011, I didn't own any property. Okay, I'd never owned property. And I was in over $40,000 of credit card debts. All right, like 8 different credit cards, lines of credit. Now, I paid off all my credit cards by April 2016, improved our family's net worth by $500,000, was making almost $500 a month in passive income when I quit my job at a local bank here in Hawaii and became a full-time mother, part-time finance freedom coach. So I created a program where I just coach clients on what I did. So I share that story to give you hope so that you understand that if you are not doing well with money, you can change your financial destiny. Okay, so today what I'm talking about is a key that if you use this key, you can change your life forever. Like seriously, when I found out this key, it literally changed how I invested my family's money. Now, I'm going to share it with you, and you can do whatever you want with this right now. All right, here we go. So, first of all, investing, okay? A lot of people say you should just invest in index funds. There's no fees. Just invest in the index. The index grows at a certain pace, and it's a really good pace. 6% annual yield, I think, recently, or something like that. And it's good to be in the stock market because cash is trash and all these things. So what about the S&P versus the All Seasons portfolio? Now, if you don't know what the All Seasons portfolio is, it is recommended by Tony Robbins in the book, Money Master the Game. Okay, it's in this book by Ray Dalio. Okay, now he does a whole analysis of it, and that is the portfolio he recommends from this entire huge, thick book. Okay, so this is the portfolio. It is 40% long-term U.S. Treasury bonds, 30% stocks, 15% intermediate term Treasury bonds, 7.5% gold, and 7.5% commodities. Balanced every year, put in low-cost index funds or low-cost mutual funds, okay? So, all based on indexes, all right? Now, let's talk about this. So, investing in the S&P All Seasons, so we can compare the two. If you invested in that portfolio with gold and commodities and all that, stocks and mostly bonds, honestly, and you invest in the S&P, what would be the difference? Now, I have a lot of blog posts about what the All Seasons is and why it's important. So today we're just going to look at the comparison, all right? So what if you invested in the S&P since 1934? All right, 1934, the year 1934, you start. What are the worst drops in the market? So he has a table here that shows you what would happen, okay? What would happen in the worst drops of the market? So let's take a look. I'll read it to you. Hi, welcome guys. Let me know your names, where you're from, okay? In 1937, the S&P dropped 35.03% versus the All Seasons that only dropped 9%. That's a huge difference, guys. 1941, 11.59% drop versus only 1.69% drop in the All Seasons. In 1973, the S&P dropped 14.69%, and the All Seasons actually gained 3.67%. Check that out. 1974, S&P dropped 26.47%. The All Seasons only dropped 1.16%. That's a huge difference. In 2001, the S&P dropped 11.89%, whereas the All Seasons only dropped 1.91%. In 2002, the S&P dropped negative 22.10%, whereas the All Seasons actually gained 7.87%. That is a giant difference, guys. You went from a loss of 22% to a gain of 7.87% in 2002. Holy smokes, right? 2008, the S&P lost 37%. The All Seasons only lost 3.93%, and that was during the housing crisis. So in my personal experience, because this book doesn't go to 2020, but in 2020, my son, who was invested in the all seasons, when the stock market went down 50%, he was only down 3 to 5%. So I know from personal experience that the all seasons really does stay more stable and doesn't drop like stock indexes do, not nearly as huge drop. Okay, some more comparisons. Since 1928, the S&P in 87 years through 2013, the S&P lost money 24 times. Okay, guys, 24 times it lost money. Roughly 27% of the time it lost money. However, the all seasons portfolio lost money only 14 times during the same period, which means 73 years of positive returns. Okay, guys? In the heart of the Depression, the 4 consecutive losing years of 1929 to 1932, that was the big Great Depression, okay? The S&P lost 64.4%. Holy smokes, right? During the same 4-year period, excuse me, 1929 to 1932, the all seasons portfolio had a total loss of 20.55%, which is 59% better than the S&P. That's a huge difference. The average loss for the S&P was 13.66%. The average loss was just 3.65% for the all seasons portfolio. That's since 1928. Okay. Now, what about the 75-year history? All right. In 75 years, that's to 2012, back 75 years, the S&P lost money 18 times. Okay. Hi, Panthers. Welcome. In the same period, the all-season portfolio lost money only 10 times, slightly more than once a decade on average, okay? Its largest single loss was in S&P. The largest single loss in the S&P was negative 43.3% in the last 75 years, whereas the largest single loss for the all seasons was only 3.93%. That is a huge difference, guys. The average loss in the S&P is 11.4%, whereas the average loss in the all seasons is 1.63%. Wow, right? So as you can see, the all seasons is much stronger than investing in just the S&P index. And these results are all net of fees, okay, guys? Now, percent growth. What about the growth, right? Which one grows more? You know, I'm like, oh, maybe it's a wild ride, but maybe it grows more. Not the case. The all seasons grows, that's the dark line, grows faster and farther than the S&P, which is that light colored line. So let's talk about that graph right there. Percent growth from January 31st, 2000, if you invested $100,000, yeah? And you went through 2000, let's see. If you look at the all season you report against the market recently, the difference is greater. From January 1st, 2000 to February 2nd, 2015, the all seasons portfolio destroyed the returns of the market, the S&P 500, okay? During this time frame, we endured all kinds of what Ray calls surprises: the tech crash, the credit crash, the European debt crisis, the largest single year drop in gold, 28% in 2013. In more than a decade. This time frame includes what experts called the lost decade, in which the S&P was flat for 10 years, from the beginning of 2000 to the end of 2009. And the difference in growth, as you can see in the chart, $100,000 invested in 2000. If you go to 2000, January 31st, 2014, the all seasons would have grown to over $300,000, whereas the S&P would have grown to less than 200,000, so 190,000, something like that. That's a big difference, guys. Over 300,000 versus 190,000. So as you can see, in terms of loss prevention and in terms of growth, the all season kicks the S&P 500's butt. Okay, guys. So I think it's clear to say that during this experiment in the book, and this is why Tony Robbins recommends the all seasons portfolio, just kick the S&P's butt. And he's like, you guys, everyone should do it. Not only that, because it doesn't lose as much money during crises, you're less likely to panic and ditch your investments when you shouldn't. Okay, so you're more likely to stay ground, keep investing, and build your return over time. So check out more about it at yesfinanciallyfree.com is my full blog post. The link is below the video on YouTube. On Periscope is the link in my profile. Swipe to the right to subscribe to me in Periscope. Subscribe to the YouTube channel. Find out more about the all seasons portfolio. If you need help constructing one, I have a beta discount, $100 off till the end of the month. So you can check that out. YesFinanciallyFree.com. Today's blog post, the countdown timer is there. $100 discount if you need help building it yourself. Aloha and see you next time. Thank you so much.